Let's bring in Evercore ISI's Mark Mahaney. Mark, great to have you with us. What's your perspective on what Netflix guided on today?
I think the two negatives were gradually less than 300 bips of operating margin expansion. This is what the company has done historically, and the CFO went out of his way to say that they're not going to grow at that fast of a clip going forward. So the most bullish estimates out there would have had that in there. I don't know what the real guidance is, but it sounds like it's maybe 2 to 3 points of margin expansion going forward. So there's certainly plenty of levers for that. And then there's a little bit of debate over some of the commentary around pricing or ARPU, or what they call ARM, our average revenue per member, in the fourth quarter, and whether that was a little soft or not. I actually thought the language was extremely vague, so I didn't read a lot into that. I think if they're going to say something specific, I pay attention to it. If it's vague, I don't. But the real key was the operating margin, cautious or slightly less bullish commentary.
I felt like that was sort of glass half full, glass half empty perspective. I mean, the CFO was sort of making the point that sometimes you don't want to grow at that rate because you want to favor growth as opposed to maximizing margin. So you view it as a negative.
Yeah, I mean, in terms of what it means is that there's probably less upside to $20 in earnings in 2025. That's how I think about it. The street's kind of at 1930. I think real bulls on the stock are higher than that, higher than 20, probably closer to 21. So maybe you trim down that 21, maybe that low 19s gets trimmed up or something like that. Let me also step back on Netflix. Near term, this writer's strike, it's a negative for Netflix. Now, it's less of a negative for Netflix than the other streamers or the studios, but it's a negative for Netflix for two reasons. It does create these kind of content holes, these content gaps, and it also pushes out when they can implement the next price increase. And so I worry about Netflix. Near term is kind of having a little bit of an air pocket. But longer term, I really like these new initiatives, the paid sharing, which is now well known by the market. But what I think is still underappreciated is the rollout of this ad-supported offering. They just took their TAM and they expanded it. It's hard to say by how much. Maybe it's 10%, maybe it's 30%. But they took their core product, cut it by 30%. That means you're going to get a lot more incremental subs in international markets. And that's one of the big takeaways from our survey work. So I want to be long for that reason.
Mark, it's Karen. Thanks for being on. So I know you've been bullish. You're very bullish now. What do you think is the right multiple for? Clearly, they're number one by a very wide margin. But at some point, things get too expensive. And I'm wondering, did it come down enough to jump in here? I know you have a much higher price target.
Yeah. And just to put it in context, amongst the mega caps, my favorites here are actually Uber, Amazon, and and Meta. I really like these. They've got some nice product cycles with those three names right here, right now. I think you're a little bit further out with Netflix, so it's not a top pick for me. But I think you can look at Netflix really easily, as you can for like the last 12 months. That's when I upgraded it. You can look at it on PE, GAAP PE. And if you can do $20 in GAAP earnings, what's the market going to pay for that? I think the market would probably pay 25 times earnings. It's currently paying more than that now. I assume a little bit of a fade in the multiple. But this is a company that's going to give you kind of mid-teens revenue growth, some margin expansion, and they're going to be buying back stock. That gives you kind of this earnings algorithm, if you will, of 20 to 25%. I think the market pays 25 times for that. So I see this path to 500. Does that make it a screaming buy here at 410? No, but somewhere solidly below 400 probably would make it a really aggressive buy.
What are some of the data points that you look at, Mark, to gauge whether or not there will be more trade down or even cancellations for Netflix? There's mounting concerns about the consumer. We've heard it from a lot of retailers about the trade down effect. I don't know, maybe Netflix is like toilet paper. You just can't live without it. But it does seem like, you're paying for it, and you might scrutinize what you're paying for in the future.
Boy, there's a lot of things. I could hit that a lot of different ways. I'll just... When we do our survey work, what we see is kind of a mature U.S. market. You see the satisfaction scores are lower in the U.S. than they are in international markets. The indications of churn are higher. I just think you've got 80 million users of Netflix in the U.S., 80 million households. So you've got the vast majority of the households. The growth has to come in international markets. So that's where we do all this survey work. What we're seeing so far is that kind of the pushback on the implied price increase, which is really what the paid sharing crackdown was. The cancel rage is starting to come down. And then we look at these markets like Mexico or Japan or Germany or the UK, satisfaction rates are higher. And it's in partly because I just think there's less at-home entertainment options if you leave the U.S. That doesn't hold for every market, I know. But for the vast majority of markets, it does. And that's where the secret sauce is for Netflix. And then you layer in these lower price points, the ad-supported offering. I just think there's another leg of growth here to Netflix. And I'll throw one other idea by you, which is that we haven't had a mega hit out of Netflix in the last, 12 months or something like that. Like, when's our next Squid Games? But you know what? Netflix is a hit factory. I don't know what the next hit is, but they've got so many shots on goal that every 12 months or something, we're going to find something really exciting that just blows out through the zeitgeist. So I just want to be long in front of that, too.